All right, welcome everybody. Happy holidays. Hope everyone's having a good end of the year. We're really excited to be hosting this Market Outlook webinar today. And what we thought we would do is Jeff is on with me. I'll go through the slides that we've prepared for today. And then what we'll do for the last 15 or 20 minutes or so is take any questions you have. So as a reminder, if you click on the Q&A box at the bottom toolbar, you can type in your question. If you don't press anonymous, it's going to show your name. If you don't want your name to be shown, hit anonymous. And you'll submit that. Jeff and I will get it, and then we'll make sure we ask the question to everybody and then answer it for everyone's benefit. Real quick technology check before we get started. Can everyone just kind of raise their hand? There should be a thing to raise your hand if you can see my screen, see me, and hear my voice. Looks to be good. Pretty much everyone has raised their hand, so thank you for that. All right, well, let's go ahead and get started. So the title of this webinar is the 2023 Retrospective Review and 2024 Market Outlook. What we're going to talk about today is we'll start with inflation and the kind of the whiplash that we have felt over 2023 in terms of the narrative around inflation. We'll move to inflation and the Fed and expectations for what's going to happen in 24. We'll look and talk a lot about the labor market, the employment picture, and economic growth. Then we'll pivot to the market and look under the hood at market performance year to date and valuation of the market. How expensive is it? We'll talk about 2024 market outlook. We'll talk about the election, and then we'll pivot to where we feel like there's the best opportunities going forward. And I'm a spoiler alert, but we really think fixed income is an attractive place to look, especially for retirees now that yields have risen. And then we'll finish with psychology, a principle in psychology of investing, something that just makes it really part of how we're wired makes it really hard for many people to be good long-term investors. And so we'll finish with that because we think it's so important. So let's dive in. We got a full plate here. So this is a chart that's showing TIPS break-even inflation. So the way to think about this is whatever the yield is here, that's what the market expects inflation to be over a 5-year or a 10-year time period, okay? So the 5-year is that kind of orangey yellow line, and the 10-year is the dark blue line. And what's so incredible is if you really look primarily at 2023, you can see the volatility around inflation expectations, right? I mean, in early 23, it was almost, the 5-year was at almost 3%. And if you go back to the summer of 22, when inflation was spiraling and people were in a panic, right? The summer of 22, inflation expectations hit 3.5%, meaning 5 years out, the market expected inflation to be 3.5%. Now, right, market's expecting inflation to go back to that long run average of 2.1%. But look at this. It moved from early November, mid-November through to current date. It dropped from 2.5% to 2%. And it was basically as a result of only a couple data points, namely inflation in October printed at 3.1%, CPI printed at 3.1%, better than expected. That combined with some jobs data, the market kind of very quickly went on an optimistic surge where bonds went up in price, yields dropped, and stocks went up in price. And it happened very quickly. We got a year's worth of returns in basically the first 2 weeks of November because of these inflation and job prints. But the point is, the market is looking at only a few data points, right, and making these conclusions. And when we zoom out, as we're going to in this webinar, we're going to see that it might be a little bit premature. So this is a chart showing job openings and quits. It's a way to get a sense as to the health of the labor market. There's different ways to look at the labor market and the economy. We're going to look at a bunch of them today. So what you can see here is look how many job openings there were in 2021 and even towards the end of 21. That has moderated, right? It's come down quickly. And a lot of the reasons for why so many economists and Wall Street were predicting a recession was the rate of change, right? In terms of the job openings coming down, PMIs falling, right? Inflation going up so rapidly, there's just really fast rate of change. So it is moderating, but there's still 8.7 million job openings as we sit here today. And the number of people quitting their jobs has also moderated, right? Remember, everyone was quitting and getting a bigger pay somewhere else, leading to more inflation. So that is moderating. But look at the average going back to 2000. It's 2.8 million quits. We're at 3.6 million. So it's coming down, but still well above the longer term average. The other thing that happened was in October, 150,000 jobs were created. And that was less than expected. The 5-month preceding average was almost 250,000. So that was cheered on by the markets, right? Oh my God, it's coming in less. That's good for inflation. But what seems to be missed is that if we look at the pre-pandemic average, right? That was kind of when inflation was that 1.5% to 2% range. It was 130,000 new jobs were created. So we're still well above that pre-pandemic average, meaning that the market's concluding things based on kind of the trend where we're heading, but we still are a ways from kind of that 2% inflation numbers that we saw before the pandemic. This is another way to look at kind of the strength of the labor market, and I think it's pretty telling. What you can see here is there's 8.7 million job openings as of October of 23. There's 6.3 million unemployed people as of November. And what this means is that every single person, it doesn't work this way, but if every single unemployed person got a job tomorrow, there'd still be 2 million jobs that are needed for employers that can't be filled. So what that means is while things are moderating, the labor market is still very tight. In fact, right, represents tightness in the labor market when it's below zero, okay? This is the tightest labor market we've seen going all the way back to 2000. Look how much slack was in the labor market after the great financial crisis. I mean, it took a decade basically to wean off this excess, right? That was when, people were happy to have a job. It was hard to get a job, right? There just weren't enough job openings and too many people looking for work. That is not the case anymore. And while it is moderating, we're still well into this, negative range here, implying that the job market and the labor market is still very tight. The highest pre-pandemic, number of job openings was 7.4 million. We're at 8.7 million approximately right now. Okay, so labor market still tight. The jobless claims number is, of all the labor data we're talking about, labor market data is inherently lagging, right? It's looking backwards in time to the previous month or 2 months. Jobless claims are released weekly, so it's much more of considered a concurrent indicator, right? It's not necessarily leading, but it's kind of like, okay, this is a real-time sense of what's going on with the labor market. And there's concern, right? There was concern amongst economists that we're going to start seeing real cracks in the labor market because of how high interest rates are and how much they expected the economy to slow. But they're not really showing signs of cracking. The jobless claims are normalizing, but not really cracking. So 230,000 jobless claims is the most recent print, which is high relative to the last 12 months. And again, why the market cheered it on, right? Higher jobless claims, less tight labor market, lower inflation. But look at the 20-year pre-pandemic average of jobless claims, people filing for unemployment, was 300,000, right? So we're still well below the long-term average. So again, markets declaring victory based on the trend, right? The rate of change we're seeing in a lot of these numbers. But where we actually land, right, may tell a different story. It may tell a different story. this is one of the things I think that isn't paid enough attention to, that has been a huge reason why the market has held up as well as it has. Look, COVID was a global, right? A global issue, and it created massive distortions. Look at how much money essentially was moved from the federal government into individuals during the pandemic, right? We had about $1 trillion in checkable deposits, like a straight line up, got north of 4 trillion. And that's a lot of liquidity sitting on people's balance sheets, right? Their personal balance sheets. So are consumers running out of excess savings? Again, if you're looking at the rate of change, very scary, right? 4 or 5 to 4 in a short period of time. But the overall level is still very high, okay? And so this amount of liquidity has allowed for a lot of these really negative headlines that we've seen about inflation and the supply chain, right, to eat a lot of those negative headlines. It's just this blob of money. And this does not even include the amount of money that people have sitting in money market accounts. A lot of the money that was moved out here didn't get spent. It just went from a checking savings account not paying anything to a money market account that's paying, 4 to 5%. So still very high levels, which again, for the foreseeable future, is going to mean that the consumer is in pretty good shape. We have read that unfortunately, the bottom quartile of consumers have been tapped out. So, right, this is not necessarily evenly distributed amongst the population. And so they are having to rely more on credit cards and debt financing. But overall, those levels are still quite high. And then, right, economic growth. Look, last year, 2023, last year, 2022, you had rates that went from basically 0% to up to 5%. You had a commercial real estate market that I think there's some question marks. Work from home is now a reality. And, a lot of these urban centers were reliant on workers who worked at office buildings and, ate out at lunch. And it's not clear whether that's ever going to come back the way that some people expected it would. So there was a lot of things flashing red, okay, in 2022. And it was the most anticipated recession by economists. It's now become the most delayed recession in history. It was the most anticipated recession in history by Wall Street economists. Now it's the most delayed recession in history. Why? Well, the economy, right, GDP, has held up a lot better than was expected. Forecast was that the economy would grow at 0% at the beginning of 2023. 0%. In Q3, the economy grew at a 4.9% annualized basis. The consensus for Q3 was 0.5%. And there is still fiscal spending that is yet to be deployed. The CHIPS Act, the IRA Act. On top of the COVID measures that took place, there has been a huge amount of fiscal stimulus that has occurred. And there was, right up until last year, a huge amount of support from on the monetary side, with keeping interest rates at zero, setting up loan facilities. They did, as a result of the bank failure, set up credit facilities so that there was ample liquidity for the banks. So the Federal Reserve and the government has done a huge amount to make sure essentially that COVID wasn't the end of us. And it's created, right? It has created very big distortions, and we're still living through those distortions. It appears to be moderating now, but we're still very much kind of in the midst of these distortions. And there's so many different factors at play, right? You have a labor market that's really tight. You have a Federal Reserve that's raised rates from 0 to 5%. It's very restrictive. You have the CHIPS Act and the IRA Act, which are going to, provide a lot of kind of manufacturing growth, a lot of infrastructure investment in the U.S. But then you have 2 wars going on. You still have mortgage rates that are really elevated. And then on top of all of that, you had this huge technological advancement I mean, it's been in the works for a long time, but now it's really commercialized and available to everyone, which is AI, right? Artificial intelligence, ChatGPT, Google's Bard. So you have these confluence of factors that are all kind of coming together, and putting that all together into a piece. I mean, if you were to go back to 2022, all right, let's do a quick thought experiment. If we go back to February 22, and we say, let's say, the market's starting to roll over, inflation seems to be sticky, and you got nervous and you say, you know what, I'm gonna actually buy insurance where if the market goes down, I'm gonna actually make money. Okay. It's called puts, what I'm talking about, or selling short. But the bottom line is you're basically saying, I think the market's going to go down. I'm getting nervous. It's February 22. You buy those puts, right? That was before the market really tanked. And let's say you bought those puts and then you got sick and you fell into a coma. Okay? Kind of dismal, but it's just the thought experiment here. If you fast forward to today and you came to from your coma and you said, what's happened in the world? Well, Bob, we had inflation in June of 2022 hit 9%, the highest in 40 years. The Federal Reserve took rates from 0% to 5%. Mortgage rates are north of 7%. We had a war breakout in Ukraine. We had a war breakout in the Middle East. And we're coming up on a very contentious 2024 election. You would definitely think that your puts were in the money, wouldn't you? But they would not be. They would not be. If you can believe it, the market, even though it did go down a lot in 22, if you look today, has recovered most of those losses. And those puts would be out of the money if you went back to February. So one, it's a good lesson in avoiding trying to time the market and trying to maintain that longer term perspective. We realize that's easy to say and hard to do, but it's so important for that reason. And two, a big part of the reason for that, right, was this. There's so much liquidity in the system that it has eaten so much of the negative headlines. Okay. And obviously economic growth and the consumer proved to be far more resilient than economists predicted. Let's talk about the Fed, right? So the Fed now this has come down in the last 2 weeks, but what this is showing you, these numbers here, is the median estimate of where the Fed funds rate, where the Fed's gonna have interest rates in each of these calendar years. So for 2024, at the end of the year, it's now, this median number is about 4.6%. It was 5 1/8. Now it's about 4.6%, but still much, much higher, right, than it was any time before the pandemic, any time really going back to 2000. And even in 2025, you can see there's a much greater dispersion amongst the FOMC members, but still at about 3.8%. It's not until 2027 where they're expecting that Fed funds rate to be 2.5, which would be more in line with kind of a healthy long-term average, but still well above, honestly, where it was before the pandemic. So we had this really abnormal period from 2008 to 2020 where a lot of the U.S. had a slightly positive yield, U.S. Treasuries, but there was a significant number of countries who had negative yields, specifically in Europe, right? That's changed now. Right, so that's been a big change coming out of the pandemic, that almost no countries now have negative yielding bonds. Okay, now let's look at the markets. Let's take a little bit of a peek underneath the hood. I think a lot of people, when they look at market returns, they just say, oh, S&P 500, oh, it's up 22% year to date. That's great. But we really do want to look underneath the hood, because it's kind of a tale of two markets. There's the market of the Magnificent Seven. Okay, that's your Tesla, your Nvidia, your Meta, your Amazon, your Alphabet, your Apple, and your Microsoft. Those companies have accounted for about 3/4 of the entire return of the market in 2023. Okay, and a big part of it was the kind of the unveiling of Chat GPT, and that kind of becoming a real thing, right? So AI has been the big driver of that. The other 493 companies are still positive, but it's a much more subdued picture, right? They're only up about 6 to 7%. So if you look at the market's return, it's had an incredible year, but the majority of that return is being driven by a very small subset of the market companies called the Magnificent Seven. And the Magnificent Seven has also driven up how expensive the market is, right? So if you look at PE, price to earnings, right? How much are you willing to pay for $1 of earnings in a company? The forward PE for the S&P 500 as a whole is about 20 times right now, which is certainly a little bit on the high end. The Magnificent Seven are close to 40 times next year earnings. And if you look at the other 493 companies, the forward PE is in the high teens. So when we look at things as they sit today, if you back out the Magnificent Seven and a few others that have kind of been declared winners in the AI world, like Broadcom, companies like that, you're left, the rest of the market is not too expensive, right? It's pretty reasonable in our opinion. But when you look at the market as a whole, it does look a lot pricier because of the performance of the Magnificent Seven. And look, those companies have very strong and powerful business models. It's worth pointing out, I think, that Meta, right? Facebook, Meta, which I know a lot of people hate. We understand that, but just from a numbers standpoint, they were just coming into an existence in 2004, 2005. They didn't IPO until 2012. So basically it went from nothing to now they're producing tens of billions of dollars of free cash flow every year. I mean, the rise of technology, okay, has been nothing short of incredible over the last 15 to 20 years. And we think over the long term, okay, that technology will continue to take share. Okay, and a big part of the reason is that their business models, okay, not all tech, but a lot of technology companies, their business models are such where their biggest cost is their engineers, their computer scientists, their developers. And AI is going to increase the productivity of those engineers by a lot. Okay. Alphabet recently said in an earnings call, the CFO said, we are going to improve our margins over time. And the first way she explained that happening was through AI. And so it wouldn't surprise us in 3 to 5 years if we wake up and the margins of some of these software companies are materially higher than what they are today. Okay, so this is just a rough sketch to give you a sense as to how Jeff and I try to think about different scenarios and what the market could look like. Here are kind of 3 different scenarios, and then a bunch of metrics and criteria next to them. It looks like right now, at least for the next 6 months, we're looking at more of a soft landing scenario, which would mean the market's, basically fully valued, but within reason. Okay. The 2 scenarios that are kind of on the tails would be we're actually at the start of a new cycle, an expansionary boom. So we have the kind of this perfect Goldilocks scenario where the economy continues to grow and do well. We avoid recession, but inflation continues to moderate. And that if that happens, then there could be definitely more upside in the markets. And then equally kind of unlikely, I think, on the other side would be a more than mild recession and resurgence of inflation. And then I think, we're probably being a little bit bearish here, but I think you would expect the market to pull back pretty materially if that happened. Again, we think that's a low probability. So we think, we're fairly neutral on kind of stocks going forward. We're not overly bullish, we're not overly bearish, but we are cautious because the market's up north of 20%. And it kind of reminds us of in 2022, where when things were going bad, nobody could foresee anything good happening. I mean, literally nothing. Rates are skyrocketing. People aren't going to be able to afford mortgages. The housing market's going to tank. Commercial real estate's going to blow up. All these things were predicted. And right now, the market kind of can only see a narrative where things work well. And we don't know what might go wrong, but we just know whenever the market is kind of on that type of a narrative, it's prudent to be more cautious. And so that's what we're more focused on right now. So this is a chart, we've talked about this a lot. I always like to come back to it because I think it's such a good reminder of, in order to get, the market over the last 100 years, S&P 500, Dow, it's averaged about 10% per year. That's a really good return. But in order to get that, you have to live through some painful periods. And what this graph is showing is calendar year S&P 500 returns, total returns, going back approximately 30 years, 35 years. And the bars, right, the dark blue bars represent the return for the S&P 500 in that year, right? So you can see the majority of the time it's been positive. You had the 2000-2002 period where you had 3 negative years in a row, very difficult period to be an investor. And then 08, obviously, we all remember that. And then last year, also very, very rough year. But these red dots, okay, the red dots are what we want you to focus on, because that is the intra-year decline that the market went through in that calendar year. So during COVID, the market dropped 34% in like a month. In 20 trading days, it dropped 34%, finished the year up 18. The market last year was down at the worst time about 24% from peak to trough, but it finished down 18. And then this year, market's up about 22. Guess what? It was down 10% intra-year. I believe twice, when Silicon Valley Bank failed, and then again in October. So look, a part of being an investor, especially in stocks, is you have to just kind of get used to the fact that market's going to go up, the market's going to go down, right? But over time, right? Over time, over years, not months, but over years, the odds get more and more stacked in your favor to have good returns, okay? People are already starting to be concerned about the election next year for good reasons. It's every time we have an election, it can be kind of a little bit startling, and no one likes change. So what we did is just looked back and said, okay, going back to the Great Depression, if we had a Democratic White House or a Republican White House, or a split Congress, or Republican-controlled or Democrat, what happened? And the reality is that which party was in control didn't really have that much of a difference in the overall returns during those time periods. The president and Congress do have control, they do influence policy, but underlying economic fundamentals, right, matter way more. And so, in the spirit of kind of what we're talking about with the markets, if we saw a material pullback because of the election results, we would view that, okay, as an opportunity to add to risk assets, add to stocks, all else being equal. Obviously, it wouldn't be for everyone, okay? Some people don't have the risk tolerance, but for those who are, have a moderate or higher risk tolerance, we would view that as a buying opportunity, okay? Here's another way to look at stock market pullbacks, okay? So this is counting the number of 10% S&P 500 pullbacks experienced by investors each year, okay? And then you have the orange yellow line showing what the S&P 500 index has actually done over time. And so it's very counterintuitive. We have these 1 pullback, 2 pullback, 4 pullbacks, 5 pullbacks, 9 pullbacks, right? Constantly the market's going up, it's retracing, it's going up, it's coming down. And what you see is over time, right, the market's risen dramatically, but in order to get there, it went through many periods, and some very volatile periods where, look at 2008, the market declined eight times 10% or more during that year alone. That's, look, we recognize that level of volatility, on top of seeing it, everything in the news, you're hearing the world's ending. It's just so hard to keep your cool, stay calm during that time period and stay invested. But this is why we do these webinars, right? To provide that education that these pullbacks that happen, there's always going to be a narrative as to why it's happening. It's going to be scary, and markets going to be worried about it, but they're very normal, right? They're very normal, and the market, there's a saying in our industry, the market climbs a wall of worry, and it's very true. Okay, so now let's talk about bond yields. I mean, I think this is the biggest change that we've seen in the market in 15 years, and what this is where we feel like there's a really good opportunity, both in 2024 and longer term, is within fixed income. These are yields, 5, 10, 15, 20% on the y-axis, and time going back to about 2013 on the x-axis. And then what you see here is different US corporate bond yields ranked by the quality of their credit. So AAA would be the most secure, CCC would be the highest risk, okay? But what you can see here is that even if you're looking in the highest part of the market, you're at still about 4.5%, 4.5 to 5% on AAA paper. And if you look back over the last 10 years, that's even after this period, this little decline here, it's still higher than it's ever been in history, okay? And if we go further up to, still kind of investment grade, and then kind of just dipping our toe into the high yield space, yields are a lot more attractive, right? 6 to 7%. And, Jeff and I feel, based on where the market is today, that higher quality, high yield, especially kind of double B, is an attractive area to be. And the reason is that if we feel like the markets it's up 20%, valuations are above long-term averages, over the next 3 years, 3 to 5 years, let's say the market can generate roughly 7 to 8%. Okay. Well, if we can invest in a double B bond, okay, where you're secured by the assets of the company, and you're a debt holder, so they're required contractually to pay you, and you can get 6.5%. Well, you're getting about 70% of the market's return, 70 to 80% of the market's return, but you're taking a lot less risk to do it, right? Because you're not in stocks, you're a debt holder. So whenever we can find opportunities like that, where the risk reward trade-off is attractive, getting 70% of the market's return, only 20 to 30% of the market's risk, that's really compelling. That's really compelling. So it's not to say we're going to leave stocks entirely, but we'll lean into things like that. And just as a comparison, this is the same chart in terms of the intra-year pullbacks and the final year returns, but of just the US high yield bond index, since that's the asset class we think is the most interesting right now. And just to give you a sense, 2008, right, the global financial crisis, intra-year was down 35, finished down 26. The stock market finished down 37. In 2009, intra-year was down 8, finished up 58. The stock market was down more and finished up 27. And I think if you continue to look throughout these years here, it doesn't mean there's no volatility. There can be, but there's a lot less volatility on the downside with pretty solid returns on the upside. Even this year, right, it was down 40% of what the market was down, and it's up 10% year to date, right? So the market's up a lot more, but the market was also down 10%. And again, this is the entire high yield market. If you were to look at double B, there would be significantly less downside across the board. So we always like to look at this kind of thing because it gives you a good sense as to kind of the return that you expect, and then how much risk you're taking to get that return. Okay, so bond sector interest rate sensitivity. This is getting a little more technical, and we're going to move to questions here shortly. But what this is looking at is the duration on the y-axis, and on the x-axis is just different categories or different parts of the bond market. So treasuries, mortgage-backed securities, investment grade, and high yield. But what this is showing you is it's saying a hypothetical 1% increase or decrease in overall interest rates would result in a 6.1% decrease or increase in the price of the US Treasury Index, okay? So when yields are dropping, as they have been the last several weeks, the treasuries, right, all bonds, okay, actually go up in value. You get part of your return becomes capital appreciation because bonds go up when rates fall. And high yield is interesting because let's say we do get a surprise in inflation and rates pop back up in 24, high yield's not going to be as sensitive to that. And it would also, right, that would also imply that the economy is probably doing well, is fairly strong. And so you're not going to sacrifice really much on the income side of the return, and you would be down less, right, because of the interest rate move, because there's less duration in high yield. They tend to be shorter term. So there's two components now to return in bonds that we didn't have before. There's the income component, right, the yield that you earn, but then there's also the potential for capital appreciation, because if rates do continue to fall, bonds will go up, right? So there's and if rates do go up, there's still cushion built in because the income part of the return is so much higher than it used to be. We can come back to that in the Q&A. All right, so let's finish. Before we move to the Q&A, we're going to finish with one of our favorite things to look at, which is a loss aversion chart. Okay, this falls under the banner of behavioral finance, behavioral economics, right? The traditional economics has kind of assumed that people are completely rational, but we know that humans, even professionals, are not rational, certainly not all the time. And so what this is showing you is utility or pleasure, happiness, okay, on the positive side, and then on this line here down here is disutility or pain, and then you have loss and you have gain. And what this is showing is that we feel twice as much pain for an equal amount of loss as we would feel the pleasure for an equal amount of gain, right? So if you have $500,000 and it goes down to 400,000, that $100,000 loss, you would feel twice as painfully as you would feel if the pleasure of the gain if your portfolio went from 500 to 600,000. Okay. So we know that this is true. This is just part of our hardwiring as human beings, right? Because from a survival standpoint, when things are going wrong, right, it risks, not being able to make it, not being able to survive. Whereas when things are going well, right, it's like, okay, well, I'm doing well. I'm above where I was, so things are okay, but you don't get overly excited about it. The reason that this is so important to remember and to focus on is that this is also the reason why being a good investor is so hard to do, okay? When the market, let's go back to 2022, the market's down 24%. Everybody's calling for recession. All of your friends, everything you read in the news is dire, okay? And you're feeling those losses, very acutely. The compulsion amongst retail investors and professionals is to actually sell, right? The compulsion is to sell to essentially mitigate the damage, right? To say, okay, because what happens with your thought process is you're down 20%, you're seeing all this bad news, and all you can think of, you extrapolate and say, oh my God, if it goes down another 20%, I'll never be able to stay retired. I'll never be able to retire. So people sell. And conversely, when the market's going up, right, there's an inherent kind of sense of complacency. And if you're not in the market, let's say you're in cash and the market's going up, it actually feels the kind of the fear of missing out is a lot like as if you're losing money, because you're seeing, oh, I'm not earning anything, and the market's up 20%. And so what do people do? They say, okay, things are looking better. It's time to get in. If there's one thing we can leave you with, it's this. Try to have the expectation that when the market's up 20+%, the risk on a forward-looking basis, 24 months out, is actually higher, and the returns are likely to be lower. Compared with after the market is down 20%, your risk is actually lower, and forward returns historically have been much higher, much better risk reward. So a lot of people, this was one of the things that was talked about at a T. Rowe Price conference that I attended a couple of weeks ago, which is when you're at the top of the cycle and the economy's firing on all cylinders, nobody thinks that buying utilities, right? That's totally counterintuitive to buy utilities in that environment, but that's exactly when it's most attractive to do so, right? Because the economy and the markets tend to be mean reverting, right? And so when people get too overly optimistic or too overly pessimistic, that's usually a time for when the market's gonna, change direction and go the other way. Not always, right? We know not always, but when there's a lot of fear out there, that's the time where you actually want to be considering to add to risk assets. And right now, when things are fairly calm, the market's up a lot, want to be a little bit more cautious. So there's a little kind of analogy for you. Imagine you have a bucket filled with colorful balls representing your overall level of happiness. The higher the number of balls, the happier you feel. On the gain side, adding balls to the bucket feels good, but the more balls you have, the less each additional ball brings you joy, right? You have this diminishing sensitivity. And that reflects the fact that we adapt to positive experiences and require greater increases in good things to feel the same level of pleasure. On the other hand, if we remove balls, the bucket feels significantly worse than adding an equal number of balls felt good. It amplifies the impact of the loss, highlighting our aversion to losing what we already possess. Why does this happen? Right? Well, one, loss is a disruption of our equilibrium, right? We tend to adapt to our current state of happiness, creates a baseline. And when we lose something, right, that's disrupted. We get a sense of discomfort. Also, losses are harder to reverse, right? Unlike gains, losses cannot be as easily reversed. And so it adds to the emotional weight of losing something valuable. And then, of course, we are human beings, so it threatens our sense of security, right? Money gives us the option to do things. And when we lose that money, we can feel, or it goes down in value, we feel like we're losing that security, we're losing that option. So the perceived threat further intensifies the pain of loss. All right. Why don't we pivot to questions? Jeff, if you want to join in a video, if anyone has a question, if you could please put it into the Q&A. Jeff, I know that there were some things that you maybe wanted to share or wanted to add in, so I'm going to bring you in here. Yep, here you are. Hi.
Hi.
So we have a lot of people on, but I don't think any questions yet, right?
No, I've not seen a question yet. So ask away, please.
We're here. Last 15, 20 minutes, whatever you guys want, we're here for questions. Is there anything, Jeff, that you feel like is worth mentioning, or additional charts you have that would be helpful to show? Or
well, I think if some of the questions kind of go in that direction, we can certainly do that. I think the one thing we like to hammer home, and I think you did a pretty good job of doing that, is just kind of highlighting the uncertainty among investors. But when we talk about policymakers and the people that have access to all of this data, the Fed got highly criticized by being behind the curve when inflation's on the way up. They're becoming, highly criticized for being behind the curve when inflation's coming down. And you see that dispersion in that dot plot you showed. It just goes to show, really, at the end of the day, we have a 30 plus $1 trillion economy with its fingers in so many other global economies and trade and foreign exchange rates, that it's very, very, very difficult to really truly understand all of the variables that go into it. And so, when we give our thoughts on the economy, the Fed does, or some other economist, or you're watching the news, it just goes without saying that, it's very difficult to truly appreciate, I think, all of the moving pieces here.
Looks like we have some questions.
Okay. All right. So the first question, you spoke of long term. I guess in our opinion, how do you qualify that in terms of years? Is that 3 years, 5 years, 10 years, 20 plus years? Yeah. How would you say?
I think look, 4 years ago today, we hadn't even, but basically 99% of America hadn't even heard of COVID. So think about how much has changed in 4 years in terms of, so I think you can make the argument 5 years is fairly long term, but really when we say long term, we mean 10 plus years.
Yeah. Okay. I know we all kind of always joke sometimes in meetings that the last couple of years each year has kind of felt like its own economic cycle with what's happened. In COVID was like a total recession and rebound within 6 months essentially. Last year felt really like a big struggle, and this year has felt kind of the opposite. It's hard, I think, for people, especially with those that have kind of the 2008 template in mind, and kind of pairing that with COVID, is these economic cycles can take 7 to 10 years to play out, and we're kind of used to things dropping and rebounding very quickly. It doesn't always work that way. It hasn't always worked that way. So I agree, probably 10 plus years is kind of a longer time frame to take. All right, next question. If anything, or what, if anything, can we do now to take into account end of year tax consequences? Mm-hmm. So that's a really good question as well.
Yeah. So one of the things that Jeff and I always are doing is looking at accounts that are brokerage accounts, non-retirement accounts, and seeing if there's opportunities to do tax loss harvesting, where we're able to sell a position that has a loss, right? That becomes a realized loss, and then we can sell another position that has a gain. And the loss and the gain, the loss offsets the gain, so you don't end up paying taxes. So I think that's one thing on the investment side. For people who are self-employed, keeping in mind contributions to a solo K or a SEP IRA. If you're not, a traditional IRA, if you're eligible to deduct it, that's another way to do a deduction. But I think the tax loss harvesting and other tax planning is, if you are going to give to charity, right, you still have some time to do a charitable contribution, which is deductible. There's different ways to do that, whether it's directly to a charity or to a donor advised fund, where you can, put more money into the donor advised fund and then have those proceeds distributed over time, not necessarily all at once or all in the next year.
Okay, very good. Going back to the slide with the 3 different scenarios, so that's kind of the 2 tails and then kind of the middle of the road. Is the middle scenario, the base case, what you consider most likely? If so, what are you expecting the market to do in 2024?
So we don't know what the market will do in 2024. I would point to, just if you look back to November, right, the market is essentially up 15% in 6 weeks. So, I think at this point, what I would expect, and this is totally speculative, right? We don't have a crystal ball. But if we get any data or any surprise to the narrative, higher inflation, actually there is a potential for a recession, something like that, or the labor market really starts to crack fast, I think intra-year we could see a meaningful pullback, right? That 10+%. But as long as we don't have, any sort of material recession, my guess is it would be just a pullback and not the start of something more pronounced. I'm not going to go ahead and say, here's what I think the market will be at in 2024. But I do feel, look, this is where the balance comes in. Long term, right? Longer term, let's just say 3 to 5 years, abandoning stocks, if there's anything we learned in the last couple of years, I think that's a mistake, right? In general, depending on your risk tolerance, but in general, that's a mistake. But on the margin, fixed income, I think, could deliver better risk-adjusted returns over the next 12 to 24 months. Jeff?
Yeah, the only thing I would add to that is, one of the things that you don't have to do as a financial market participant or an investor is really figure out what is going to happen next year. And the reason is because the market's kind of discounting what it feels like the future is going to deliver. And so I think you can always start with the premise of what is the market sort of pricing in right now. And that's not always easy to do. We talk a lot in the office of like, all right, well, this sector is up today, that sector is down today, or lagging materially. Is this a risk off day? But that's kind of interesting because yields are up, but tech is up. I thought tech is really kind of sensitive to rising rates and trying to divine what's happening here. But the one thing we know for sure is what analysts are expecting in terms of 2024 earnings is 11, 12, 13% earnings growth. And we have a market multiple that's kind of at the higher end of the range, as Josh kind of mentioned. So things are, last year we could look and say economists are pretty pessimistic, expecting a recession. Stocks were down 25%. If you thought a recession was likely, you would have had to have said essentially earnings were going to go down further, and price multiples would stay the same or go lower, right? And if a recession did not materialize, stocks would be materially higher. And now we have to say kind of the flip side is, in order for stocks to go up more, probably from here, materially more, I would say more than kind of the standard kind of 8 to 10%, we have to see a really big reacceleration, I think, of growth. And we're told, I think you should be open to something like that. The amount of fiscal stimulus that's coming in, rates coming down to kind of reinvigorate the housing market and corporate borrowing, and et cetera. That's certainly a possibility, which is why it's on that slide. But ultimately, what we have to do is kind of probability weight kind of each of those scenarios and make sure that we're getting paid for that risk. So the next question is, so for 70-30 now, you talked about potentially moving some more in bonds, kind of given the relative attractiveness. I guess where would you see like a 70-30 portfolio or 60-40, kind of plus or minus?
Yeah, it's a good question. So I think what we would say is we're pretty neutral right now in the portfolio. Mm-hmm. So a 60-40 is currently at a 60-40. Interestingly, we were underweight by a couple percent. And then when we got that 10% pullback in October, Jeff and I kind of had a algorithmic way where we added kind of systematically, and then at the 10% level we put in. Now that we didn't know that it would turn on a dime, that was we're not market timers, but we were just adding to risk assets because the market was selling off on a narrative that we didn't think really was anything other than just a sell-off. So fairly neutral, where I would say we're how we're deploying kind of the high yields. It's a really good question. Is we're within our defensive sleeve, which is fixed income. We're taking parts of what was treasuries or corporates, and adding to things like floating rate and high yield. Now, if the market continues to march higher, we probably would go a little bit underweight. Okay, so underweight meaning if it's a 60-40, we might go to 58% stocks, 57%. We never want to get too far out. But Jeff and I have learned over the last 15 years that positioning matters a lot. And especially when you're managing people's money, right? We don't want to get caught off sides, right? So if the market does pull back and we're neutral to underweight, we're in a position of strength to add to risk assets in that environment. And conversely, right, if the market's going up, we may miss a little bit on the upside because we're trimming some, but we're okay with that. Anything? I mean, I think that answered the question. Is that anything to add?
Yeah, to me that is. And if Tim, if you need a little bit more detail or whatever, happy to email separately, or more specifically to your situation. We had another question on the ratings agencies, because you've seen this movie before. They've downgraded the U.S. Rating. Do bond yields support that downgrade? I think the idea is, are bond yields have they priced that downgrade in? I think is what the question is really driving at.
Well, you want to start?
Well, again, that's always kind of the difficult piece, is understanding what the market in fact is priced in. I think what the market is kind of primarily focused, and that has really come into focus the last couple of weeks, even more so the last maybe 6 or 7 weeks since the end of August, is really inflation. Inflation has been kind of driving not just the bond market, not just the short-term rates market, but also the stock market. And I think we saw that initial kind of short-term reaction after the ratings downgrade, but it's really not a focal point at this point. Maybe I will share a couple things here.
Please do. You should be good to share.
Just because I did talk about in that other question, kind of what's priced in and how that can kind of impact things. So this is a little bit outdated. There's been, like I said, there's been a lot of movement, especially in the fixed income market over the last couple of weeks. But we see here what the FOMC is, which is the Fed. With that blue line represents essentially where they feel like they should be cutting or kind of raising interest rates. And the market is essentially this tan or gold line. And the market is really already pricing in a significantly more amount of cuts than I think the Fed is. So that kind of, to get back to your question, is not directly related to kind of the rating agency. It's relative, because there's more of a focus on, I think, where inflation is. That's where the market's really focused on right now, and not so much these other things. And there is a lot of other variables that should be in focus, I think. And I would kind of point to, this is, the fiscal spending impulse has been very significant over the last 10 years. Typically what we've seen is, obviously, as the economy is growing at potential, fiscal spending kind of drops because there's inflationary pressures, et cetera. But we've seen the last 10 years a much larger degree of fiscal spend. And a lot of that has helped the economy. Here's really construction spending. It's been pretty dramatic. And that's part of the reasons why I think the economy's remained so resilient in the face of kind of rising interest rates. So another question. We typically look at our portfolio returns as one number. So like you're up 10%, down 10%, but it's a composite of different investment strategies. So we have bonds, we have stocks, we may have, real assets. We might have within stocks, we may have different sectors, et cetera. Can you drill down into a portfolio and show clients the returns on specific sectors or strategies you discussed, just like bonds or just tech, et cetera?
Yeah, definitely. We can drill down by position. We can look at returns by asset class. And we can also look, sector returns, if that would, that would be more relevant if we're buying kind of a particular sector ETF. But yes, I mean, we can drill down on, okay, up 10%, how much are bonds up, how much are stocks up, how much is US up, how much is international up, how much is large cap up, how much is small cap up. Yes, we can do all that.
Okay. A couple more questions. Do you feel the Fed is, excuse me, confused about the economy and why historical data seems out of whack? Low unemployment, not generating increasing employment costs, for example. Yeah, I mean, well, you go ahead, Josh, if you want
to. No, please. I was just clarifying that it was what the question was, are they like behind the curve? Are they out of touch? Is that?
It says, is the Fed confused about the economy and why?
Well, clearly,
historically, yeah.
I mean, clearly, I think the Fed is somewhat confused because, right, they have more economists, more compute power, more data than any other organization in the world. And they got the inflation thing very wrong, right? I mean, they called it transitory until it was not transitory. And then it became a really big issue. They took rates from 0 to 5% in 18 months. I mean, let's not forget the last couple of years have been crazy. And now, right, they were saying they weren't going to cut it all in 24. And now there's projected for 3 cuts in 24, markets thinking 6. So the Fed, I think directionally is doing the right thing. But Powell, I think, does a very good job at those press conferences, just threading the needle. I mean, perfectly. But no, they're dealing with incomplete information. And like Jeff said, we have a massive economy. There's millions of variables, and the one big variable that they can never get exactly right is human behavior, because that's not predictable. So
yeah, the second piece of that, low unemployment, not generating increasing employment costs, for example. I don't know exactly what you're driving at there, but there's this concept of the Phillips curve, where as we reach full employment, wages increase that drive inflation. I think and you spent a couple minutes on that earlier with the JOLTS data, so the job openings and jobs available. And the Atlanta Fed does a really good job of tracking wage data for people that are basically kind of sitting in their existing jobs and getting raises, but also kind of moving to new jobs and jumping to new jobs and kind of tracking their labor, their wage increases. And wages are growing in the 5 to 5.5% range. So I mean, that's a substantial part of in America. I think a lot of the deflation we've seen is kind of a resolution of the supply chain issues, which relate primarily to goods as opposed to services. And so services, a big component of that is our wages, right? I mean, a lot of our clients, us, we're part of the services economy as opposed to kind of the manufacturing side of things. And, people that are sitting there are still experiencing pretty decent wage gains, which on one hand you say, well, that's great, right? For a long time, those people were lagging. But on the other side, that has a directional, feed or direct feed through to inflation. So I think they're very, very aware of that piece of it. The JOLT stuff gets a lot of publicity, I think, every time that it comes out. So
yeah.
Okay,
and one thing just to add on in terms of what's going to happen next year, I think we talked about AI, artificial intelligence, but one of the big takeaways from some of the really, really well respected and great track record from some of the managers at T Rowe at that conference last month was it was a little bit surprising, but he said basically it would not surprise him if we woke up 5 years from today and unemployment was materially higher because of AI. He mentioned that there's a Wendy's in Ohio that I'm sure no one's been to, but apparently there's an AI option. So there's no one there to take your order. It's just AI. And I think I saw Jeff and I saw, was it McDonald's? Someone else also is piloting that. So, jobs in the tax space, customer service, it's going to be, look, it's going to be very disruptive. And it's not exactly clear how it's going to play out. But that over time will be a little bit more of a deflationary force. So I think that I know we're at the past the top of the hour here. I think we've answered basically all the questions. If they're oh wait, let's see a little bit more. Hold on. Which companies over the next 5 years would you expect to join the Magnificent Seven, and which would you expect to drop out as performed like a mature company? So that's a good question. It's a really good question, actually. So I think companies that have the potential to join the Magnificent. So one company I think they could drop out of the Magnificent Seven, and this is not so much, I'm not commenting on the company itself as much as the stock, because we think it's really overvalued, and I know we have clients who really like it, but I think Tesla, their AI solution, for autonomous driving, I think that's a big part of the story for them. And they got the Cybertruck that had very meager, kind of meager initial feedback, even from Tesla enthusiasts. So I don't know. I mean, Elon Musk is tough to bet against, but I think Tesla may struggle in terms of its future returns, but we've been wrong on that. So we'll see. A company that may join the ranks of the Magnificent Seven. I mean, those companies, they're tough to catch, to be honest. You think about it, right? Apple has a market capitalization of $3 trillion. But one company, a couple companies I think that are really, maybe it's not join the Magnificent Seven, but this is not individual stock advice. You have to, obviously take this with a grain of salt. But an interesting company to us would be a company like Intuit, actually. Intuit owns TurboTax. They own QuickBooks. They own MailChimp. They own Credit Karma. But the reason that they're interesting in terms of how disruptive they could be is they have very advanced AI capabilities now, and they have a ton of data. And when it comes to tax stuff, right, that is one of the things that really can be done through AI, right? You have the data, you have the algorithm, machine learning works, and they've done a really good job kind of figuring out a way to monetize that, where someone can pay marginally more and not only get AI, but have AI pair them with a human expert. So I think they're firing on all cylinders with AI. So that would be one I think is interesting. Have to be a little bit careful talking about individual stocks on these types of webinars. But another one, Salesforce with, again, as an enterprise client relationship manager, they've already done very well. But they could continue to do very well over the next 5 years as if they can unlock, use AI as a way to unlock connections in their clients' data to help them serve customers better. That could be extremely meaningful. So maybe those are two of the ones kind of under the radar that are pretty interesting. So hopefully that gives you a little sense. But yeah, just on valuation, Tesla is really tough to make sense of. So I think that is it. You know, you guys, we're here all day if you we're happy to talk about this stuff all day if you want, but I know it's 10 after the hour, so we'll say goodbye for now. We'll see you guys in the new year, and if anyone has any follow-up questions, please reach out. We are here and happy to serve. So have a great weekend.